welcome to our first episode of Inside Private Credit. This podcast is part of Woodbridge Learning, which we established a few years ago now, really focused on giving education to the advisor market, how private credit works, a bit of mythbusters, trying to keep it simple, that kind of stuff. Like all of our Woodbridge learning sessions and our education materials, our intent is to try and keep this podcast pretty simple. We're not trying to deliver complex theories or thesis through these. It's just to have, good, simple black and white chats. Really to go beyond the headlines, to get through the noise of credit, I guess to unpack the mechanics of private credit, definitely, how we originate deals, how we underwrite our loans, how our portfolios are constructed typically in private credit. And, most importantly, of course, what wealth advisors and financial advisors should be looking for when allocating their clients' capital to private credit. We'll also bring a lot of insights into these podcasts as well. So we'll definitely be talking to other lenders, developers, advisors, industry experts in our space, and multiple people that are actively operating in our market to get their view. This is obviously not just our view. We certainly want to get people's opinion on where we sit. And I think it's important to note that, with Woodbridge Learning, we've got two simple rules, and it's a bit like Fight Club, is that we're not here to sell product, and we're not here to tell you how amazing we are. And what we're here to do is talk plain English, no bullshit, no mayo, black and white, private credit. And, our intent is genuine for our advisors and the advisor networks, is to assist them understanding the asset class and, ultimately make it better for their underlying investors and make it better for our industry as a whole. So I think a good place to start really with our first podcast is to go back to basics. So Damien Casey's here with us today, who's our head of distribution. Damo and I have been selling our product, if you like, for nearly 5 years now. So, but more importantly, we've spoken to hundreds of advisors about private credit, and we've certainly seen the evolution of private credit over the last 5 years. Welcome, Damo.
Thanks, AT. It's great to be here. Very exciting. First of hopefully many that we do. But yeah, you're right. We've done plenty of these. I think we had some data run last week. I think we just tipped over 100. I think early this year that we've done since we've started on this Woodbridge Learning, or the learning stuff we've been looking at. So we do get a lot of questions, of course, but they are also very consistent, I think, which is great. So, why are we doing it? We just wanted to create something that, is more about the asset class than the strategy. Yeah. Like create a resource for advisors to go to that, they can work out where it fits, what it is, what the risks are, etc. That they can do on their own and learn more about the strategy. So, plenty of these over the years.
Do you think it's getting easier or harder for advisors in this space? There's a lot of noise constantly. There's a lot of jargon thrown around, often inconsistently. Do you think the advisors we speak to, it's easier or harder for them these days?
I would say definitely harder. I think with more products coming to the market, the way PDSs and IMs are set up, and we both know that we've been through a few of them, and they are they are very complex, a lot of stuff hidden, and for the everyday advisor looking at asset class that to a lot of them is quite new is definitely confronting. And I think, I think for us too, is that even the experienced guys, when we're doing their sessions, will say to us, can we just take a step back and, look at, what actually is private markets and where this private credit fits in. So, and of course, that's where, we've got a lot of these questions going for.
And common themes, Damo, I mean, there's, and obviously you're doing a lot of these every week, but I assume there's a lot of common questions from advisors as a theme. Is there an underlining sort of tone to these other than just asking what we do?
Yeah, look at there's plenty, and there's probably I reckon probably 10 or 12 that are very consistent across all the 100 we've done. But the first one is always very much around what is private credit, and more importantly, what is private markets, and how does private credit fit in? So and
listen, I think for investors in Australia, private markets is new, isn't it? It's not something that advisors have been used to. Investors into private markets have typically been family offices, high net worth investors, and all of a sudden they've got private markets opened up to them in terms of obviously private credit, but also private equity. You've got a lot of funds coming in now that are giving wholesale investors and now retail investors access to private markets. And advisors have all of a sudden gone, geez, it's private. I can't Google these things, so I'm very reliant on the manager. So I think for advisors, they're getting used to private markets. Private markets is not bad, as you know. We're always saying this. It's just different. If you invest in equities, and you're investing in Amazon, you can Google Amazon and you can form an opinion. But when you're investing in a private credit fund, you can't Google the assets every day and find out what they're doing. So you've got to trust your manager. So it's not good or bad, I think. But it is different. You're right. And I think there's a lot of confusion around, is private bad? It's just different. And globally, private markets are alive and well. Just Australia, we've been spoilt for choice, I guess, in the public markets.
Absolutely. And it brings into the fact that, probably the main thing that we probably hear more about is transparency. This word has really started to pick up, and I think advisors, as in unlisted assets in what we play, you can't just jump on a computer and look at our daily prices and stuff like that. That you can in the equity markets.
And listen, I certainly know in the 2015, 2016 private credit, very, very opaque. Advisors just didn't ask for the loans in these portfolios, which always seemed a bit odd.
Probably didn't have to ask for.
Yeah, correct. 100%. Yep. So, and as they're learning out that they need to ask, it's, of course, I think they're saying, well, what do I ask? So, it's a word that's thrown around a lot, transparency. To me, it's normality. I think it's just, if you don't know what you're investing in, don't invest in it. It's pretty simple, and most advisors get that. But make sure you can see what you're investing in, and if you're not comfortable with the asset class you're investing in, I guess make sure you know that. Or ask someone what questions to ask the asset class you're investing in, because in private markets you're very dependent on the on the investment manager.
Look, and that's the thing, it's getting talked about more and more. Private credit in general is kind of coming up a lot, and, it's getting looked at more for, investment portfolios. But to a lot of advisors, it's still a very unfamiliar and probably scary, to an extent. So, I think we should probably just start with the basics of, what comes up about, I suppose, what is private credit, and how does it work?
I think, just at its simplest, it's just lending, We are non-bank market is lending money from private investors into borrowers that are normal borrowers. They are ex-bank borrowers, most of them. With the retreat of the banks in this space, is that non-bank lending is lending from the private market to borrowers of capital, and there's different types of lenders, obviously. But really, it's just that simple. It's called a lot of things. It's private credit, private debt, non-bank lending, private markets. It's all the same thing in lending. It's just lending from one pool of private money, not bank retail deposit holder money, into borrowers.
And it's a really good point, because I think for private credit, a lot of people feel that, it's quite new and it's a new exciting asset class. It's just hit our markets. But, in hindsight, it's been around for decades.
It has, And I think, there's definitely a myth that this is everyone's discovered gold. It's private credit is absolutely not new. It's been around for decades. And certainly, we've been lending money from the private capital into borrowers for, since the 80s, 90s in Australia. But wholesale retail investors weren't investing money in those debt instruments. They were all either insto, high net worths, or private family offices. So I think with the explosion of funds and wholesale product and platforms giving product, and then retail coming in, you're seeing a lot of people pour into it. And I get it. People going, oh, wow, this is shiny and new. It's not. But I get it. It feels like it's shiny and new because there's just hasn't been a lot of education around it. So
and that plays in just to the sheer growth we've seen in the asset class, especially even over the probably last 2 or 3 years since we've kind of come more into the space. But it's gone from being in niche portfolios to really becoming a mainstream part of investor portfolios, hasn't it?
Yeah, well, it's the challenge for advisors, obviously, being as the bond market's retreated and the spreads between bond and 10%, if you like, there's not much product. Yeah, so
Yep.
as an advisor, when you're putting clients into between 4 and 10, where are you putting them? And for
Yep.
advisors, if you want fixed income, where are you going?
Yep.
Is that so? The traditional fixed income products have faded, and private credit, definitely has come into that space. So I think a lot of advisors probably feel like they've been forced into private credit, which is a phenomenon in itself. Is that it's an asset class they may not have done before, so they have to go into it, and then they have to understand it. And then when they open it up, they're going, "Oh my God, it's called seven things. The IMs and PDSs, they're extremely long. How am I supposed to find out simple things like fees?" So, yeah, I think that's been the frustrating part. I think from the advisor side, it's just they want to be in it, but how do they get in it, and how do they pick through it, and how do they pick which fund to invest in, and which part of their portfolio does it fit? Is it fixed income? Is it alts?
Yep.
And I think, the advisors are very much making their way through that now, aren't they?
Yeah, and it's an interesting point you make around is it alts, is it fixed interest? Probably 5, 3, 10 years ago, whatever you're looking at, you'd probably say most people say it's all alt.
Yep.
It's what is it? We don't understand it. It's high risk. But as the asset class has evolved, what are you seeing? Is it you're seeing is it alts and fixed interest, or are we kind of seeing it as both, or where does it really play out?
Listen, I think the frustrating thing for me is that the risk return on private credit has been deliberately greyed by fund managers, so that for advisors, they're asking, well, what is the right risk return for private credit?
Yep.
Well, you can't answer that because you're saying, well, what part of private credit are you talking about? Are you talking about a fixed, a first mortgage fund, a corporate debt fund? So they're all very different. So I think the hard part for advisors is that they can't mash it all together. They wouldn't mash equities together.
Yep.
So it can, private credit can be fixed income. And I think that blows the head off a lot of new advisors in this space going, whoa, it can't be fixed income. It doesn't have the characteristics of fixed income. Well, it can. It can have capital preservation. It can have monthly distribution. It can have non-correlation to public markets. So it can have the characteristics of fixed income. So it can be fixed income. It can also have the characteristics of alts, and it can earn 12, 15%, 20% returns that you would typically expect in alts, but then it's got alts risk. So I think what a lot of the big shops have done in private credit is kind of mash that conversation together, and the risk return has got mashed with it. So for advisors, I think I'm always saying, just why are you using it? If you're using it for alts and you're investing in something that's 8%, well, you wouldn't normally put that in your alts pool. Are you doing it for liquidity? What is it? So there's a as you know, there's a lot to unwrap around all of that, but it's just another product. Yeah, it's not.
Yeah, and I suppose it's opening up what we talk a lot about, in this space, is that split us up.
Yeah.
There is more private credit. Australian equities aren't Australian equities. There's small caps, large caps, infrastructure sector.
Yep.
You've got to do the same with private credit, and I think that's really opened the eyes up to a lot of advisors that didn't realise there was more to it. I think when you actually go underneath, with the loan types and whatnot.
Yep.
So,
and I think that's a good comparison, Damo. Is that it's just advisors should just think of it like equities. There's short, as long as global, domestic. So you cut equity. They're used to cutting equities up like that logic, and they're doing that for risk return. They're doing that for spreads. They're doing that for liquidity. Credit's just another asset class, very similar. So they should take the same mindset initially, and like when they're investing in equity funds, they'll get to the manager eventually and rip the manager. That's perfectly normal. But I think credit, they should start with why are they there? What's the risk return they're after? You don't enter an asset class just saying I want liquidity. Well, that's not, obviously not doing that normally. So, and then when they get to the advisor, when they get to the underlying investment manager, as you know, in private markets, that's the important thing. You must, because you're in private markets, the trust and transparency of the manager you're in is very important in private markets, because you need to see everything to know when your risk returns out. So. Yeah, I think there's probably one thing we haven't spoken about quickly that we can kind of touch base, of course, is the risk.
we talk a lot about risk, and most people do in asset classes, but for us is, where the risks are. And I suppose for the advisor is always asking me, how do I look for the risk? What risks am I looking out for? And, what are the common risks that we see, in private credit?
Yeah, again, I guess I'd say it depends what the advisor wants to use the product for, and are they seeking 15% returns for risk? And clearly, there's more risks at that level. Not bad risk, but there's more risks, and there's some very good funds that are spitting out those returns with good risk management. Or are you looking for a 6% product in private credit? And again, you would expect that they're very low risk. So, I think for advisors as they rip through it, just obviously they're the experts in portfolio construction. We're just a dumb investment manager. So we're here for our product, and we're all the same as managers. And then the advisors should be picking product based on what they're building their portfolios in, and their job clearly is the risk return question. Our job as managers is to make sure that we understand that, we articulate it, and we manage it clearly. And I think simply, as long as we're all doing that, we're all fine. I
think one thing comes up is around the fund structure, the LVRs, valuation, are the loan type, where the loan is, as I suppose we're saying about breaking up the fund and breaking up the loan types, it's also really breaking up the risks, that can come about it, and really simplifying that, I've seen that a lot, and done a lot with that, the basics of LVRs, the basis of valuation, why capital cities, why regional, these things that, I think is only going to get more, come up the scope with education. And I think you've seen that as well.
And as you know, this is the nightmare for advisors. Just LVR. What does the L mean? What does the V mean? Does the R is it defined? No. Does ASIC define it? No. Where is it in the PDSIM? It's not, probably. So advisor hits that and goes, okay, so how am I supposed to know what that is? And that's just one example. Just there's we all call it the same thing 10 ways. Advisors invest in 10 funds, they'll get 10 definitions. So again, very hard for advisors if the private market is forcing them to sort of dig deep. And AI's probably made that a bit easier for a lot of advisors to screen PDSIMs, to find the bullshit and to find the hidden bits in it and to bubble that up. I think that's a good thing. But the industry shouldn't be doing it. And I guess that's always my frustrating thing. But I think as you know, I think education to me is the key in this space. And I think, we've always been always saying that we think the advisor network are going to bring change to this industry, not ASIC. And I think, you've been peddling that for a while as well. And I think that's right. I think, all these education sessions are about just, giving advisors the tools to dig through.
Ask the right question. What questions do I ask? There's 5 or 6, 7 questions that, an advisor can ask. I think they can really split up funds when they thought they really couldn't. So I think that's, so beneficial, and it's come from a lot of, the sessions that have happened over the last 2 or 3 or years in doing.
And we're seeing it, aren't we? We're seeing good advisors now get used to the questions.
Absolutely. And be confident with it. Like really going back at the manager when the manager would say, well, that's not how private credit works. Well, I think what the new advisor's saying is, I'm sorry, that's not how it works. I have options now. I didn't have options 5 years ago. That's where it's at. So, if that can continue to happen, that will change this space. It won't be a law that comes in 2, 3, 4 years' time. It'll be already entrained by the demand and where it comes from. It's the financial planners in Australia.
Oh, absolutely, And that, obviously that the advisor network's going through its own change, and I'm very positive about it. I think you're probably the same, but I think it's, that the advisors are getting better, smarter in this space. They know what to ask. They're driving the structure of funds. They're calling bullshit on the old structures, the hidden fees. And that's all good stuff for our industry. I think that's perfectly normal. And I think, we're not the only one educating in this space, but I think the more education in the asset class it gets, the better for everybody. I mean, it's better for investors, clearly. It's better for advisors. They've got trust in product. And I think for every investment manager, it's, if the bad ones need to be forced into line, I don't think it's a bad thing. And I get a lot of advisors say, well, that's not our job. Well, sure, but in the absence of a regulator, I think it is. And I think, we've all got responsibilities in the space. And I think increasingly advisors are kind of getting it. The good ones are really getting it, aren't they? They are.
Yep, they are, really are. And they're demanding it, and they're kind of saying, I can't understand it. I'm not using it. The days of just looking at the return and saying, well, it's a, guaranteed number of 9%. They're gone. They're actually wanting to come underneath.
Yep.
And because it's not a niche product anymore. It is a mainstream product in fixed interest and alts, which is exciting for the asset class. Absolutely. So,
I had a good one last week. I met a guy looking at one of our products, ripped me a blue one on just what we do, how we do it, bang, 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 12 questions. And then it's refreshing. I think that's those type of advisors coming in know exactly what they want. They know where to look. They know the questions to ask. And
5 years ago, that was
that's right, yeah. And whether they decide to invest or not, I mean, sure, that's their job, yeah. Not that we don't care, but that's not our job's to build product. But I think that's positive. I think that is good for industry, and those people are educating people underneath them, and I think that's the change. I think what we are reacting to as part of Woodbridge Learning is it's been a bit slow in the space, and because the regulator's not educating. I think we would like to speed it up. Clearly, I know I've spent a lot of time doing that too, and I think, as long as it's done in good intent, I think it's a good thing. Yeah, like if advisors don't want it, fine.
Yeah, and it's evolving along the way. When we first did this session 3 or 4 years ago, it's very different to what we do now because it's feedback from the advisor. What are these questions coming in that we're missing that they want to talk about? And I think that's what's driving all of this today, and where this series has come from. It's just that constant feedback. Can't make a session, but if they can listen to something like this and get a real no BS kind of, feedback on the asset class, I think, it's only a good thing.
And I think that's probably a good space to leave this first one, Dame. I mean, as you know, we could crap on about this for days in terms of how to set this up. And but I think you've been pretty consistent too. Just education is the key. Just if we can clear the decks through these, I think that's the key. Don't talk product, talk the black and white of it. I think if you've made it this far in our first podcast, we haven't bored you to death. Thanks for listening. You can certainly find out more information about Woodbridge Learning on our website. There's a lot of resources and there's also show notes on these podcasts. And thanks for joining Woodbridge Inside Private Credit.